Chapter 10, Assessing Investment Risk in Real Estate, a deep dive into key performance indicators investing in commercial real estate, whether in industrial warehouses, office spaces, or mixed-use properties, requires a strategic approach to manage risk and ensure profitability. Investors rely on a blend of financial performance metrics, income stability measures, operational efficiency indicators, and market positioning insights to determine a property's potential for revenue generation, value appreciation, and resilience to market fluctuations. In this chapter, we'll explore the essential metrics used by investors and underwriters to evaluate a property's investment risk and how each metric contributes to a well-rounded analysis of property value. 1. Financial performance. Gauging profitability and return potential. The backbone of any investment decision lies in assessing a property's ability to generate income and, ultimately, deliver returns. Financial performance metrics like net operating income, NOI, effective gross income, IG, and capitalization rate, cap rate, play central roles in revealing a property's profitability and its attractiveness as an investment. Net operating income, NOI. NOI represents the income generated by a property after subtracting operating expenses. It's calculated by deducting costs associated with maintenance, utilities, property management, and other operational expenses from the property's gross income. A high NOI indicates that the property generates significant revenue relative to its costs, making it a valuable asset in the portfolio. Investors look for a steady or increasing NOI over time, as it suggests consistent cash flow. Effective gross income, IG takes the property's total potential income and adjusts it for vacancy rates and potential credit losses, providing a more realistic view of expected earnings. IG helps investors understand how well the property attracts and retains tenants. By accounting for vacancies and collection challenges, IG gives a more conservative and dependable income projection, aiding in more accurate financial planning. Capitalization rate, cap rate. The cap rate measures the return on investment by dividing the NOI by the property's purchase price. Higher cap rates indicate better returns relative to the investment cost, but a very high cap rate may signal higher risk. Cap rates vary by property type, location, and market trends, so investors compare them within relevant market contexts. A cap rate that's in line with or better than the local average is a positive indicator, while a low cap rate may suggest limited growth potential or high initial investment costs. 2. Income stability. Ensuring reliable revenue streams. Reliable income is critical for real estate investments, especially when planning for long-term returns or high financing leverage. Occupancy rate, tenant credit quality, and lease expiration schedule each contribute to the property's revenue predictability, revealing both immediate and potential future income stability. Occupancy rate. This metric indicates the proportion of rented versus vacant units in a property. A high occupancy rate suggests consistent tenant demand, resulting in stable income. For office properties, high occupancy rates reflect a strong market position and low vacancy risk. In high-demand industrial areas, occupancy rates close to or above the market average further strengthen an investor's confidence in the property's stability. Tenant credit quality. High-quality tenants are less likely to default, providing security for the income stream. For example, if an office building leases space to financially stable corporations, the property is more likely to yield reliable cash flow. Conversely, lower quality tenants may increase the risk of non-payment, which could harm profitability. Lease expiration schedule. This schedule details the timing of tenant lease expirations. Properties with staggered leases reduce the likelihood of simultaneous vacancies, preserving income flow over time. A balanced expiration schedule prevents large vacancies from occurring all at once, making the property less vulnerable to revenue disruptions and creating a more reliable income source. 3. Operational efficiency. Balancing costs with income and debt management. Operational efficiency can make or break an investment. Properties that effectively control operating expenses and service debt demonstrate stronger resilience and profitability. Operating expense ratio, OR, and debt service coverage ratio, DSCR, provide insights into a property's ability to manage costs relative to income and meet debt obligations comfortably. Operating expense ratio, OR, this ratio represents the proportion of operating expenses to effective gross income. Lower ratios are preferable, as they indicate that the property generates more income than it spends on operations. High ORs might suggest inefficiencies, excessive maintenance needs, or high utilities and staffing costs, which can erode profits. Comparing a property's OR to market averages helps investors gauge its competitiveness and operational stability. Debt service coverage ratio, DSCR, DSCR measures a property's ability to cover debt payments from NOI. A DSCR above 1.25 is generally desirable, indicating that the property earns enough to pay off its debt obligations with a buffer. Properties with low DSCRs may struggle to meet debt payments if NOI fluctuates, especially during economic downturns. Investors should be cautious of properties with a DSCR close to or below 1, as these may require additional funds to meet debt obligations, increasing the investment's risk. 4. Market position risk. Contextualizing competitiveness and long-term value. Market metrics provide a contextual framework for evaluating a property's competitive standing, investment safety, and potential for value appreciation. Market rent versus in-place rent, market vacancy rate, replacement cost, and loan-to-value ratio, LTV, collectively reveal the property's market position and long-term potential. Market rent versus in-place rent. This comparison helps identify opportunities for rental increases. If market rents exceed current lease rates, the property has potential for future income growth, especially when leases renew. For example, if the average industrial space in an area commands $20 per square foot but the property's leases average $17, the owner has an opportunity to raise rents over time, enhancing revenue. Market vacancy rate. Comparing a property's vacancy rate to the broader market provides context for its demand and competitiveness. A lower than market vacancy rate implies strong tenant retention and a market appeal, while higher vacancy rates may indicate issues with tenant demand, location, or property condition. In commercial real estate, staying close to or below the market vacancy rate signals stability and appeal. Replacement cost. This metric represents the cost to replace a property with a new one of similar size and functionality. If the acquisition cost is significantly below the replacement cost, the property is likely a good deal, as it would cost more to rebuild than it did to purchase. This gap also indicates potential for property appreciation, as market values generally approach replacement costs over time. Loan-to-value ratio, LTV. LTV measures the size of the loan relative to the property's appraised value, serving as an indicator of leverage. Higher LTVs suggest greater reliance on borrowed funds, increasing financial risk, especially during economic downturns. Lenders typically prefer LTVs below 75%, providing a cushion against value declines. For investors, a lower LTV indicates lower financial risk and greater resilience in fluctuating markets. Putting it all together, comprehensive risk assessment. Each KPI discussed above provides a critical data point in a comprehensive assessment of investment risk. By evaluating these metrics in tandem, investors can build a thorough understanding of a property's financial health, income reliability, operational soundness, and market positioning. A balanced, multifaceted analysis enables investors to make informed decisions, mitigating risk while positioning themselves to capitalize on growth opportunities. In real estate, successful investing requires blending quantitative analysis with a keen awareness of market trends and economic factors. Financial performance, income stability, operational efficiency, and market context work together to build an investment profile that can withstand volatility, drive steady returns, and enhance portfolio resilience. By understanding and leveraging these metrics, real estate investors and underwriters can better navigate the complexities of the commercial property market and unlock long-term value in their investments.